Lesson 10 Introduction to SPACs. Lesson 10 Case Studies and Success Stories. Study real-world examples of successful SPAC mergers or acquisitions. Here are a few examples of successful SPAC mergers or acquisitions that have occurred in recent years. DraftKings Incorporated, DKNG in 2020. DraftKings, a sports betting and daily fantasy sports company, merged with Diamond Eagle Acquisition Corporation, a SPAC backed by media executive Jeff Sagansky and sports executive Harry Sloan. The merger allowed DraftKings to go public and raised approximately $500 million in gross proceeds. Following the merger, DraftKings has experienced significant growth and has become a leading player in the online sports betting industry. Virgin Galactic Holdings Incorporated, SPCE Virgin Galactic, a space tourism company, merged with social capital Hitasafia Holdings Corporation, a SPAC led by venture capitalist Chamath Palihapitiya, in 2019. The merger provided Virgin Galactic with access to public markets, raising approximately $800 million. It allowed the company to accelerate its plans for commercial space flights and brought increased attention to the space tourism industry. Multiplan Corporation, MPLN Multiplan, a healthcare cost management solutions provider, completed a merger with Churchill Capital Corp. III, a SPAC led by Michael Klein, in 2020. The merger valued Multiplan at approximately $11 billion. It enabled Multiplan to strengthen its position in the healthcare industry and pursue growth opportunities in an evolving healthcare landscape. Open Door Technologies Incorporated, Open Door, an online real estate marketplace, merged with social capital Hitasafia Holdings Corporation II, a SPAC sponsored by Chamath Palihapitiya, in 2020. The merger allowed Open Door to go public and raised approximately $1 billion. The transaction provided Open Door with additional capital to expand its operations and disrupted the traditional real estate industry by streamlining the process of buying and selling homes online. These examples highlight successful SPAC mergers that have enabled companies to access public markets, raise capital, accelerate growth, and disrupt traditional industries. It's important to note that the success of SPAC mergers depends on various factors, including the target company's fundamentals, market conditions, post-merger execution, and the ability to deliver on projected growth. Investors should conduct thorough due diligence and consider the unique characteristics of each SPAC and its target company before making investment decisions. Analyze the factors that contributed to their success and investor returns. The success of SPAC mergers and the resulting investor returns can be attributed to various factors. Here's an analysis of the key contributing factors. Target company selection. The selection of a high-quality target company is crucial to the success of a SPAC merger. Successful SPACs typically identify target companies with strong growth potential, innovative business models, and solid financial performance. These target companies may operate in emerging industries, possess unique technology or intellectual property, or have a competitive advantage in their respective markets. A well-chosen target company can attract investor interest and contribute to the overall success of the merger. Management expertise and track record. The expertise and track record of the SPAC's management team play a significant role in the success of the merger. Experienced management teams with a proven track record of identifying attractive investment opportunities, executing transactions, and driving value creation are more likely to attract investor confidence and deliver positive returns. Investors assess the management team's ability to navigate the due diligence process, negotiate favorable terms, and successfully integrate the target company post-merger. Growth potential and market positioning. The growth potential of the target company and its ability to capitalize on market opportunities are critical factors. SPAC mergers with target companies operating in high-growth sectors, such as technology, healthcare, or renewable energy, have the potential to generate significant returns. A target company's market positioning, competitive advantage, and ability to capture market share also contribute to its success and, in turn, investor returns, synergies and value creation. Successful SPAC mergers leverage synergies between the SPAC and the target company to drive value creation. These synergies can include cost savings, operational efficiencies, cross-selling opportunities, access to new markets, or enhanced technological capabilities. The realization of these synergies post-merger can enhance the target company's financial performance and generate returns for investors. Investor confidence and market sentiment. Investor confidence and market sentiment towards the specific SPAC and the target company can impact investor returns. Positive market sentiment, driven by factors such as market demand, favorable industry trends, or positive media coverage, can contribute to the success of a SPAC merger and drive investor returns. Investor confidence is influenced by factors such as the reputation and track record of the SPAC's management team, the quality of due diligence conducted, and the transparency and accuracy of information provided to investors. It's important to note that the success of SPAC mergers and investor returns is not guaranteed, and there are risks and uncertainties involved. Market conditions, execution risks, regulatory changes, and other factors can impact the outcome. Thorough due diligence, careful evaluation of investment opportunities, and diversification of investment portfolios are essential for investors to manage risks and make informed investment decisions in the SPAC space. Learn from the experiences of companies that have gone public through SPACs. Companies that have gone public through SPACs, special purpose acquisition companies, have provided valuable insights and lessons from their experiences. Here are some key learnings from companies that have undergone the SPAC process: due diligence and target selection. Thorough due diligence is critical when selecting a target company for a SPAC merger. Target companies should be evaluated based on their growth potential, market position, financial performance, and alignment with the SPAC's investment thesis. Conducting comprehensive due diligence helps identify potential risks and ensures that the target company is a suitable fit for the SPAC's objectives. Investor communication and transparency. Clear and transparent communication with investors is vital throughout the SPAC process. Companies that have successfully gone public through SPACs have prioritized investor communication, providing timely updates, addressing investor concerns, and ensuring transparency regarding the target company, the transaction process, and the post-merger business plan. Open and effective communication helps build investor trust and confidence. Post-merger integration and execution. The post-merger integration process is crucial for the success of a SPAC transaction. Companies need to focus on executing the identified synergies, integrating operations, cultures, and systems, and effectively communicating the strategic vision to stakeholders. Successful companies prioritize the integration process and ensure a smooth transition to maximize the potential value creation of the merged entity. Long-term planning and execution. Companies that have gone public through SPACs emphasize long-term planning and execution. They establish clear strategic objectives and develop a robust business plan that outlines the path to achieve sustainable growth and profitability. This long-term focus helps investors understand the company's value proposition beyond the initial hype associated with the SPAC transaction. Regulatory compliance and governance. Adhering to regulatory requirements and maintaining strong corporate governance practices are critical. Companies that go public through SPACs understand the importance of compliance with securities regulations, maintaining accurate financial reporting, and implementing effective internal controls. They prioritize good governance practices to build investor confidence and ensure long-term sustainability, flexibility, and agility. Successful companies that have gone public through SPACs demonstrate flexibility and agility in responding to market changes and evolving industry dynamics. They remain adaptable to changing market conditions, customer preferences, and technological advancements. This agility allows them to seize growth opportunities and navigate potential challenges in a competitive environment. Continued investor relations. Companies that have gone public through SPACs recognize the importance of maintaining strong investor relations even after the merger. They engage with shareholders, provide regular updates on business performance, and foster open communication to sustain investor trust and support. Ongoing investor relations efforts help maintain a positive relationship with the market and facilitate long-term value creation. These learnings highlight the importance of thorough due diligence, effective communication, post-merger integration, long-term planning, regulatory compliance, and ongoing investor relations for companies going public through SPACs. By incorporating these lessons, companies can enhance their chances of success and deliver value to shareholders in the long run.